The great rotation in favor of value investing is just beginning. Expect strong returns from the value style. There are still great undervalued companies to invest in, and you can still earn extraordinary returns from the long-term investment strategy. The great rotation has barely begun, urging investors to shift from growth to value strategies. If you want to keep your portfolio growing and healthy, you need to ensure that a significant portion is invested in the asset class with tremendous potential for future returns. Strong market forces push stocks towards value, but it will take more time to reshape portfolios. What if you held a value portfolio that was also a winner? Can you make it happen? Research shows it's possible if you follow one of these strategies. Welcome back to the Ring of Knowledge, your trusted source of practical financial knowledge. Today's video will discuss which stocks you should buy by considering value and growth. What are value stocks? Value stocks are often characterized as those that trade at a lower price than their inherent value. The price of a share of stock that has been estimated based on either the expected future development of the company or the total amount of assets and liabilities that the company now possesses is referred to as the stock's intrinsic value. These companies are generally able to pay out higher dividends to shareholders than their growth counterparts because their products and services do not require as much reinvestment as their competitors' products and services do. Sectors commonly associated with value stocks include financials, energy, or industrials. However, there has been a shrinking availability of value stocks. In September of 2022, approximately 75 value stocks were included in the S&P 500. More than 125 value stocks were available to investors in 2012. The S&P 500 Value Index was developed by S&P Global and is a value stocks measurement using the financial ratios of book value, earnings, and sales to price. The criteria used by the S&P Global to identify value stocks include both Coca-Cola and Procter & Gamble. Plus, over at least 60 years, each corporation has increased the dividends they pay out. What are growth stocks? When determining which companies are considered growth stocks, S&P Global looks at a company's sales growth, the ratio of earnings change to its price and momentum. The rate of increase or decrease in the price of a stock is referred to as the stock's momentum. When compared to value companies, growth stocks have a greater propensity to be focused on the healthcare and technology industries. According to S&P Global, value companies are characterized by sales growth, momentum, and the ratio of earnings change to price. Apple and Tesla are examples of modern corporations currently regarded as growth stocks. Over the past 10 years, both have garnered widespread recognition for the consistently excellent returns that they have generated. Value versus growth. Two ways to invest in stocks. When it comes to investing in stocks and stock mutual funds, there are two primary strategies, sometimes known as styles: growth and value. Value investors are looking for equities that appear to be inexpensive in the marketplace, whereas growth investors are looking for companies that provide substantial earnings growth. When used together, the two styles can offer a greater sense of variety to your portfolio because they complement one another. Growth stocks have been showing above-average improvements in earnings over the past few years and are predicted to continue generating high levels of profit growth. However, there are no guarantees that this will continue. Corporations considered emerging growth companies have the potential to produce significant profit growth, but have not yet established a history of incredible earnings growth. There is a list of essential qualities that growth funds possess. Number 1. Prices that are higher than the market average. Investors are willing to pay high price-to-earning multiples with the anticipation of selling their holdings at even more excellent prices as the companies continue to grow. Number 2. Record-breaking increases in earnings per share, although the profitability of some companies can decrease during times of more gradual economic progress. And growth companies can maintain significant earnings growth regardless of the state of the economy. Number 3. More prone to swings than overall market. When investing in a particular growth stock, you run the danger of seeing its stratospheric price plummet dramatically in response to any negative news regarding the firm, particularly if profits fail to meet expectations. The managers of value funds are always on the lookout for firms that have fallen out of favor but still have strong fundamentals. The value group can also consist of the stocks of new companies that have yet to earn the attention of investors. These key characteristics define value funds. Number 1. Prices that are lower than the market overall. Value investing is based on the assumption that the share prices of solid companies will eventually recover if and when other investors acknowledge the stock's genuine worth. Number 2. Listed at a price that is lower than comparable businesses in the industry. Many value investors believe that most value stocks are created because of investors overreacting to recent company problems, such as disappointing earnings, negative publicity, or legal problems. These issues can raise doubts about the company's long-term prospects. Value stocks can be created when investors overreact to recent company problems. Number 3. Carry a lower risk than the market as a whole. On the other hand, value stocks may be better suited for investors who hold positions for a more extended time and may be subject to a greater risk of price volatility than growth companies. That is because value stocks require more time to turn around. How growth and value investing overlap. A great deal of fuss is being made over a somewhat unshakable distinction. For instance, during the course of its existence, a stock's characteristics can shift from value to growth or vice versa. In the discussion of value versus growth investing, it is crucial to remember that both types of investors have the same objective: to buy low and sell high. The only difference is how they go about achieving this objective. Investors that focus on value seek out businesses that have already established a track record of success, but whose stock prices are far lower than what they should be. Growth investors seek out businesses that have the potential to grow in the future and anticipate that the stock price will rise when the businesses either meet or exceed their potential. A variety of routes can be taken to reach the same desired destination. Investing in growth and value stocks. The stock market passes through cycles of varying lengths that favor either growth or value strategies, depending on which cycle is currently active. During the bull market from 2009 to 2020, the companies included in the Russell 1000 Growth Index fared better than those in the Russell 1000 Value Index. However, this may only sometimes hold on a year-to-year basis. One of the available choices is to put equal money into both of the techniques. Together, they offer the potential for rewards when either strategy favors favoritism within a portfolio, which adds diversification to the equity side of a portfolio. Because the market swings through cycles of value growth, you should review your investment strategy and consider rebalancing it regularly to ensure that your portfolio remains in the allocation you desire. Value or growth, or both at the same time. The debate over whether it is better to invest in companies that exhibit growth or value has been going on for years, with both camps using data to support their respective positions. Value investment has produced better returns than growth investing when compared on a value-adjusted basis over lengthy periods. Value investors contend that a concentration on the short term can frequently drive down stock prices to low levels, which subsequently presents value investors with an excellent opportunity to make purchases. Growth stocks generally perform higher when interest rates go down and strong earnings go up. This is especially true in recent years. On the other hand, when the economy begins to slow down, they can be the first to feel the effects of any punishment. Value stocks, which are often equities of cyclical industries, have the potential to perform well in the early stages of an economic rebound, but are more likely to underperform in a protracted bull market. Deflation of expectations and untruths. The S&P 500 fell by 57%, the NASDAQ fell by 78%, and the tech-heavy NASDAQ 100 fell by 83%. These declines culminated in the crescendo low in October of 2002. The most apparent investment opportunity from a speculative point of view was found in the beaten-down technology companies for investors looking for substantial value. Although they were trading at levels much below their intrinsic value, several of the most heavily damaged stocks continued to be housed in growth indexes. The forward price-to-earnings (PE) ratio of the technology stocks included in the S&P Growth Index was 20.5 in October 2002, significantly lower than the 25.6 forward PE of the technology stocks included in the S&P Value Index. This occurred when the market was at its lowest point. In other words, a significant number of the most inexpensive stocks in the technology sector were discovered in the Growth Index. Not only was the classification detail important for determining the actual worth, but it was also crucial for moving forward performance. When specifically looking at the NASDAQ 100, the index that suffered the most damage during that time, we can see that the members of the index who had lower multiples tended to fare better when the new bull market began. When the market bottomed out, the median future PE for members of the NASDAQ 100 was 22.6. During the subsequent 10 years, the performance of the stocks that had a forward price-to-earnings ratio of less than 22.6 was significantly superior to that of the stocks that had a forward PE ratio of greater than 22.6. Therefore, screening for the simple value feature of a forward price-to-earnings ratio that is lower resulted in higher returns, even in an index that was heavily weighted toward growth. Taking into account factors in the current situation. The rapid and significant swings in sector leadership that occur monthly, weekly, and sometimes daily have made positioning the industry over the short term a challenging and unsettling task. As a result, determining the trajectory of the performance of both growth and value has proven to be just as challenging and confusing. Even in industries that might not be considered growth or value-oriented, the environment has become less choppy and more consistent due to applying a factor-based strategy to navigating it. For instance, value components have done well in the growth-oriented technology sector. Since the beginning of 2021, the value factor of high free cash flow yield has significantly outperformed the growth component of long-term expected profit growth within the technology sector. You should go with growth stocks if you don't consider your portfolio to be a source of income, and you will only use the money for some time in the foreseeable future. Because growth firms typically reinvest their revenues back into the company to drive further expansion, dividend payments from these companies are uncommon. Since you know that lofty objectives require significant amounts of time to accomplish, you can provide your stocks as much time as they require, fulfilling the development potential that they have indicated. You are under the impression that you can successfully select winning stocks in highly competitive emerging markets. In the rapidly developing industry, dozens or hundreds of competitors will likely compete for a large portion of the market. To be a successful investor, one needs to have a strong understanding of the technology underpinning a company and a strong intuitive sense regarding the ultimate prospects of a company. You have a high level of comfort with taking chances. Because many competitors are striving to one-up each other, a company's prospects can shift depending on the news cycle. The ability to adapt quickly requires a strong stomach. You should go for value stocks if you look at your investment portfolio as a potential source of revenue. Paying substantial dividends is one of the defining characteristics of value stocks. When a company's underlying business is experiencing slight expansion, this is one strategy it might employ to boost the appeal of its stock. You favor steady stock prices and can avoid getting caught in value traps. Since consistent economic conditions contribute to a lack of swing in share prices, value stocks typically do not experience significant price movement in either direction. You know that a low stock price does not necessarily indicate that a company's stock is an undervalued value. There is usually a good explanation for why a stock's price is so low, and a prudent investor will recognize when a low valuation is an indication of uncertain future company prospects. You want to see a return on your investment in inexpensive stocks in the shortest time possible. Even while value stocks aren't known for their rapid growth, there's potential for gain if the right business makes the correct moves and outmaneuvers its rivals. The most astute value investors seek out companies with such characteristics and purchase a significant number of their shares before the market becomes aware of the trend. When will value outperform growth again? When value stocks become more profitable than growth stocks is a subject that has been on the minds of many investors recently. The quick response is that nobody has an idea. The extended response is that nobody is aware of this either. However, they know that the market will eventually favor value equities. When thinking about how value once again becomes the preferred option, there are a few things to keep in mind. Inflation is a warning flag that should not be ignored. Inflation benefits the value of equities more than growth stocks. At the beginning of 2022, inflation skyrocketed to a level not seen in the previous 4 decades. As a result of rising energy prices driving up inflation and increasing investors' expectations for higher interest rates, several classic value sectors have been performing exceptionally well as of late. These increases led to a surge in the value of energy in financial corporations in 2021, as investors anticipated more substantial profits at these businesses. A favorable adjustment in the near-term outlook would eliminate much of the anxiety and pessimism currently holding value equities back. It is anticipated that value stocks, which are expanding earnings more swiftly than growth stocks, will begin to outperform due to this move. Taking a stance on growth and value is a complex endeavor, especially at the market's extremes compared to the average. It is impossible to take a position favoring one investment strategy over another using a broad-based approach because traditional growth and value indices are rebalanced slowly and infrequently. Sector leadership can shift quickly, and there are varying definitions of the pure growth and value characteristics. Given that there are frequently significant discrepancies in the performance and construction of growth and value indexes compared to the factors and characteristics of growth and value, we recommend that investors take more of an approach based on factors. So that's all for today's video. If you like this video, click the like and the bell buttons. We'll have another video for you soon. Take care until then.